Good morning. This is CRE360 Signal for Friday, October 24th, 2025. Today, Florida unlocks a structural tax advantage. New York's office market posts a 19-year leasing high. Houston's retail landlords hold firm, and investors are quietly betting on a San Francisco rebound. We start in Florida, where the state has officially repealed its 57-year-old commercial lease tax, an extraordinary policy shift that cuts tenant costs by roughly $900 million a year. The October 1st repeal immediately reduces occupancy costs by about 5.5%, translating into 25 to 50 basis points of effective cap rate compression for most assets. Economically, Florida is still expanding at about 2.7% GDP growth, with population up 1.7% year over year, among the strongest in the country. Institutional investors are already responding. Lenders have tightened spreads for Miami and Orlando, and underwriting models are being updated to reflect lower effective rent burdens. In short, Florida just made itself even more competitive, and the market knows it. Meanwhile, Manhattan tenants leased 23.2 million square feet of office space through the first 9 months of 2025, the highest total since 2006. That's a clear reversal from the national picture, where office leasing remains about 11% below pre-COVID averages. This surge is driven by a flight to quality. Over 143 leases topping $100 per square foot have been signed year to date, already more than all of 2024. Deloitte, Amazon, and other major tenants are expanding footprints, while at least 6 new developments have restarted, a first since 2020. Manhattan, in effect, has reestablished itself as the benchmark for what a functional post-pandemic office market can look like. Meanwhile, in Houston, retail landlords continue to hold the upper hand. Average asking rents sit at $20.51 per square foot, triple net, just a tick below last year's all-time high, while vacancy remains a tight 5.6%. Leasing reached 1.8 million square feet in the third quarter, but new construction dropped 41% year over year, keeping supply in check. Strong in-migration and resilient consumer spending mean national retailers are still paying to play. In fact, experiential users, from indoor pickleball to boutique gyms, are absorbing older boxes and preserving occupancy above 94% metro-wide. Houston shows what happens when development discipline meets durable demand. Out west, San Francisco's office distress is drawing opportunistic buyers. The historic 800 Market Street building sold for $17.2 million, or $344 per square foot, more than 60% below its prior valuation. Citywide vacancy remains about 31%, the highest in the nation. Yet investors like Fountainhead Development and Brady Sullivan are moving in at land value pricing, betting that tech hiring and conversions will gradually rebuild downtown. It's painful, but it's also how recoveries begin. Price discovery first, occupancy later. Across these markets, the message is discipline. Capital is rotating toward clarity and credit. Tax efficiency in Florida, premium tenancy in New York, constrained supply in Houston, and deep value in San Francisco. Operators who underwrite with precision and focus on durable income are the ones capturing today's upside. Looking ahead, policy tailwinds could spread as other states evaluate business cost reforms. Office rent gaps between top-tier and mid-tier assets will widen, and retail should remain one of the most stable income plays through 2026. This has been the Our Today's Signal. For charts and the full newsletter, visit CRE360.ai. Research-driven and built for operators. Have a wonderful Friday.